Hello again, everybody. Dr. Richard Smith here with Cycles TV, back for another week of macro cycles analysis. Reader's choice. Want to know what's on your mind? We're going to look at a few ideas that were proposed by readers last week. So get your ideas into the chat if you would like us to look at your ideas. And finally, putting the pieces together into real market decisions using risk management and cycles together. So continuing to build on the work we've been doing over the past month. And while I mention it, a brief shout out to our Masters Working Group. This is really the brain trust of the Foundation for the Study of Cycles, an incredible group that I get so much benefit from to help me work through what's going on in the world, what's going on in markets, how to understand cycles and use them in real life. So we have a few openings left for our Masters Working Group for people to join. We're maxing out at 50 members. So if you're interested in a serious cycles think tank where you not only learn, but you contribute, we would love to have you consider joining the Masters Working Group. So with that, going to get into, we had a great session yesterday with the Masters Working Group, and going to be sharing a little bit of that learnings today. And also a shout out to Lars von Tienen and his excellent show yesterday on the MOVE Index. Going to be covering that here also today, because it really ties into the overall macro thesis that we've been developing, which is that there are headwinds for further market gains at this point in time. So with that, let's get into it and review kind of where we stand in the macro thesis, and then start drilling down into some specifics. I think we're going to be covering Ethereum, high yield growth, and probably even the cannabis sector, which a reader asked for coverage. So yes, well, Chaser, what a name, the MOVE Index. Yeah, I agree. Great one. All right, let's get going. So we're just going to start out here by revisiting our macro thesis here. And let me just make sure I can see everything that I need to see here across the two. Come on. Where'd you go? Okay, great. So we've been expecting CPI inflation to creep up by the end of 2025 into 2026, as followed on the very striking 65-month cycle in inflation and unemployment that we've been tracking for a while. We did see some uptick in core inflation with the reads on CPI last week. We started to talk about that. Look, the momentum on inflation is increasing, right? The bottoms are higher here, and we're moving into the up phase of the cycle. So the overall thesis, one of the big theses, is inflation increasing as a risk going into 2026. And same thing in PPI, producer price indexes, which we've said for a while are going to lead CPI. And indeed, that's what we saw with a huge upside surprise in PPI last week. I am really surprised that markets have held up as well as they have in light of what we saw in the PPI last week. It was like way above expectations. So not quite sure why markets are having a delayed reaction to this, but we continue to see this thesis unfold that inflation is a risk. And why wouldn't it be, right? You got deglobalization, you got costs rising, input costs. I don't know about you, but anything I think about doing that involves real world stuff, actual things that have to be delivered and built, are increasingly expensive. So I actually think the Fed is doing the right thing at the moment of wait and see. I remain concerned that there's going to be political pressure to lower rates prematurely and that that's going to backfire in the long run. But we'll see. Unemployment also, we've seen tick up in that. We had the huge spike during COVID, which has kind of skewed everything on this chart. But unemployment is drifting up in spite of immigrants leaving the workforce. And looks like there's going to be tailwinds for increasing unemployment through the middle of 2026, at least. So that's the big macro thesis. And tying that into what Lars covered yesterday in the MOVE index, this is the bond volatility index, kind of like the VIX for the bonds, for the bond markets. And the treasury market is much vaster than the equity markets. Okay, bonds are a much bigger market than equities, and that matters. And if there's a lot of volatility in the bond market, that puts further drains on liquidity. So that is what we're expecting. And the MOVE index, this is the weekly data on the MOVE index, definitely see momentum coming down, right? And it has not turned up. Very clear cycle on the spectrum here at 187 weeks. What? Have we seen that cycle somewhere before? Oh, yeah. That's the 41-month cycle that we see in equities too, right? So it's going to likely be inverted from equities, which indeed is what we are seeing here. So far, the MOVE index has not really responded to the updrift of the cycles, especially, similar to what we've seen in equities, which we'll look at here in just a minute too. And, we broke the lows in the MOVE, and momentum isn't showing a momentum divergence either. So I wouldn't say that this is imminent, that the MOVE is about to shoot up, that bond volatility is about to increase dramatically, but this is absolutely something that over the next 6 months, we'll be keeping a close eye on, and is a very important element of our overall macro thesis. That's the weekly data. If we look at the daily data here on the MOVE, we're drilling down a little bit more now. We do see a little bit of a positive momentum divergence here. Let's just zoom in on this, right? So here was a low in December of 2024, momentum low here. Now we've got a new low in the MOVE with a higher low in momentum. Okay, so we are seeing a little positive momentum divergence here, and definitely heading into a significant cycle tailwind for the MOVE. So this supports the idea of more bond volatility in the short term here, over the next few months, and not surprisingly topping around October of 25, which of course we know is often the seasonal low in equities. So more evidence from the macro data that we should be cautious about further gains in the markets here, and that there is a good reward risk opportunity to the short side, right? I've been saying for a month now, this is not a back up the truck moment in equities. If you're a trader and you're looking for a short-term trade opportunity, I think there's a asymmetric opportunity between the risk of a correction, a sharp correction, versus further sharp gains, especially into October. We've been tracking the geomagnetic data. Also, the gold line here is the actual geomagnetic data. The cycle says it should be turning up, but it has not turned up yet. It's still making relative lows. So not really feeling the increased anxiety that comes from more geomagnetic storms yet, but cycle certainly suggesting we could see that any day now. Tying that all into equities, right? We have the weekly data here, the 187 week. That is pretty interesting, isn't it? That there's the 187 week or 41, 42 month cycle in equities here, as well as over here in the move, right? 187. So I guess that shouldn't be terribly surprising, but nice to see the confirmation there. And we've been tracking the major momentum, negative momentum divergence. We've got new highs without a new high in momentum, going into the heart of the downtrend of the 41-month, 42-month cycle. Meanwhile, we're at new highs, right? We can't be in denial about that. And so again, it's an asymmetric opportunity. And if we drill down to the daily data, we also see here in the S&P 500, some pretty strong cycles, 119 and 168, very high stability, right? And even this, what's the other one I chose here, the 79, right at the edge of stability, but very good definition in the spectrum. So 1, 2, 3 there. Got negative momentum divergence from here to here. Even just in this last two highs, negative momentum divergence, and cycles pointing down. So again, risk into October, early November is what the cycles and the seasonals suggest. Same thing in the futures data here for the S&P 500. And even drilling down to the 4-hour data here on the futures. Actually, this is 2-hour data, I should say. So we got a pretty big cycle here at 186. It's probably about 2 weeks, 2-week cycle, maybe 3 weeks. Equities kind of flatlining to down, right, with significant momentum deterioration. So all of that suggests to me, again, an asymmetric opportunity for a correction over further sharp gains. So that's the picture from a macro point of view, right? We've got likely liquidity constraints from increasing bond market volatility, inflation, unemployment, 41, 42-month cycle headwinds in equities, daily cycles in equities also suggesting headwinds. And all of that paints a pretty clear macro picture of the markets. Now, going to go a little deeper here now and talk about bonds and yield curves. So bear with me. I know this is heady stuff, but it's key to really putting together a very solid view of what's going on in the markets and what we can expect over the next, 2, 4, and 6 and 12 months. Okay. So before I dive into that, just want to give a little ask for you to make sure you're a subscriber to Cycles TV. We're putting out incredible content. We can't do it without you. And it's a huge help to us if you make sure that you're subscribed to Cycles TV. And also if you put your comments over in the, in the comments section. More engagement on YouTube is going to help us reach more people with what I hope you agree is pretty unique work when it comes to market analysis available on the internet for free. So appreciate your support. Tell a friend, make sure you're subscribed, give us some likes, some comments, and let's keep going. All right, so we're going to move now from the macro picture in terms of inflation, unemployment, evaporating liquidity, equity cycles headwinds, okay? And we're going to start to talk about the yield curve. So I use this site, USTreasuryYieldCurve.com. Okay, and I've put here the yield curve for US Treasuries 3 instances a year apart: 2023, 2024, and 2025. Okay, so here's where we are right now in 2025. The blue line, we've got, let's go out here to where we care about. Here's 2-year yields right now at about 3.77. Is that right? And 10 years are out here at about 4.34, and 30 years, 20 and 30 years out here at about 5%, right? So if we look back at 2024 here in the red and 2023 in the gold, we had what was known as an inverted yield curve, right? The short-term rates out here at 3 months, 6 months, 1 year were higher than the longer-term rates out here, at 10, 20, and 30 years. So that inversion has more or less gone away. We're still inverted at the very top of the curve here, where the shortest term rates are higher than the 2-year rates. And but the longer term rates have gone up over the past couple of years. And so the yield curve, especially between the 2 and the 10-year yields, are not inverted anymore. So where are we likely to go over the next 6 to 12 months? Let's take a look and see if we can tell. So we're going to look now at the cycles and the momentum on each of the different treasury durations: 2 years, 5 years, 10 years, and 30 years. Starting out looking at the weekly data here. I've gone back a little further than usual. I'm using 1,300 bars here to get a little more data. And with that, we have some pretty good cycles here: 303 and 230 in the 2-year. This is weekly data now, right? So this is going out quite a long ways. 300 weeks is like 6 years. So we see the 2-year not quite topping yet between these two cycles, but definitely kind of waning momentum, although not moving down yet. So maybe a little room left to run in 2 years over the next few months. We'll see. We'll see. But momentum is not really inspiring. If we look at the 5-year, similar picture, also 300 and 226, but it's even kind of closer to its top. And let's see, I'd say overall, the 2-year has had more gains than the 5-year. 5-year's kind of flat, not making new highs. Similar place in momentum, with the top band really coming down dramatically. So 2 years maybe slightly more bullish than the 5 years. The 10-year looks a lot like the 5-year. And, we see the same cycles, 224 and 300, basically, but closer to a top. And the 30-year, very uninspiring in terms of momentum. Do have some good, higher lows in momentum for sure, but also kind of moving towards a top. So all of the weekly data across 2-year, 5-year, 10, and 30s suggest, pressure on interest rates. Prices going down means yields going up. But it looks like the short end of the curve, might not go up as fast as the long end of the curve. So maybe over the next few months, we might get some, I guess they'd call that a bear steepening, where interest rates are tending to go up, but the long end's going up maybe a little faster than the short end. If we drill down and look at the daily data, okay, here's the 2 years. Near a top, I don't have the momentum on here. Deteriorating momentum. The 5-year, same situation. 10-year, similar. And the 30-year, similar. So all that lines up with the idea of increasing bond market volatility, increases in the MOVE index, increases in interest rates. Doesn't bode well for the Fed riding to the rescue in the next few months. For me, kind of comes together with a overall hypothesis of the Fed not cutting rates, seeing pressure down into an October, November low in equities, high in bond market volatility, and then maybe, Fed coming to the rescue from political pressure and cutting rates, rally into 2026, and then I'd say an even more asymmetric opportunity to the downside. So that's kind of the picture that I'm seeing across the different macro views. I do have a little more data we could look at just briefly. This is the commitment of traders on treasuries. These are the 1 to 2 year treasuries. We see, they're the commercials, the smart money are buying in the 1 to 2 years. Where did we go? Okay, these are the 4 to 6 years. And this is where they're the most bullish. This is also sometimes called the belly of the curve. If we go back and look at the yield curve one more time, sorry if this is too confusing, but right here, the belly of the curve where the rates are the lowest is kind of in between 2 and 5 years. And that's what we see reflected here, where commercials are buying the most of that duration. Okay, and then they're less bullish on the 6.5 to 10 year and less bullish on treasury bonds. So that paints the picture overall of kind of continuing with the yield curve about where it is, but everything may be shifting up a bit as prices start to come down in bonds and rates start to go up. All right. Let me just take a break here and see what's on your mind. Guillaume, good idea to short the NASDAQ, actually. We'll see what we can do, Guillaume. We'll take a look. All right. Hyperlink of Cycle TV, please. I'm not sure what you're asking there. Oh, happy day. But maybe support can help you out. Yield curve recession setup is loading. So that's kind of what I'm seeing. I'm not sure it's going to be a recession. I do think Trump has incredible executive power, or the United States has incredible executive power, and Trump isn't afraid to use it, obviously. But I think that is the natural conclusion of the cycles. I'm just not sure how much intervention there's going to be from the top. Market leads, Fed follows, cuts will come as market drops. That's kind of what I'm seeing. Fed has no levers left to pull. I gotta hand it to too late Powell to have been resisting the political pressure so far. The Fed actually has a history of studying cycles. Arthur Burns, I know he's not an incredibly popular Federal Reserve chairman, but he was a student of cycles, and cycles certainly are more studied in the bond markets than they are in the equities markets. So this is not new to the stuff. Neither, by the way, is geomagnetic data. The Fed has papers on geomagnetic data, and their impact on equity prices. Whoa, what do the commercials know? Well, they know that the 4 to 6 year, is kind of the belly of the curve. There's probably, risk to the longer duration because of the debt. And then the shorter term, it's like, oof, if CPI and PPI are going up, then it's not going to be fed to the rescue. So that 4 to 6 years is kind of the sweet spot. All right. Would you mind looking at Apple? Can look at Apple. Yep. Hitachi Brothers Band. All right. Hi, Joe. Check it out. Michael, thoughts on trading options, covered calls? I'm not really an options expert. So I just can't help you there. They cut 7 times in 08, still fell 58%. Yeah. I don't know if we're there yet, Swell Chaser. Something would have to change big. Some kind of shock, which is not out of the question, right? There's plenty of shocks that could happen. But I think it would take a shock to get us into that kind of 08 scenario currently. Maybe in a year or so. It's another story. All right, so with that, let's now take our macro point of view and go look at some individual ideas of what's going on. I'm going to pull up some charts that people asked for last week. And if you have some ideas that you would like us to explore, particularly looking for ideas that could contribute to our diversified portfolio of trades supported by cycles. So with that, let's take a look at a few things that people asked us to look at last week. One of them was Ethereum. And this is one of my private dashboards where I track the futures that I am trading on different time frames, 5 minutes, 30 minutes, okay, or daily. One of the things that jumps off the chart here is this 10 on Ethereum, plus 10, which is actually a bearish score. So Ethereum, in terms of futures, okay, has, not surprisingly, okay, we'll just start from scratch here, but look at what's going on with Ethereum here. It has had an absolutely massive run from 1,500 to 4,700 since the April bottom. That is over 200% gains in 3 months. Okay. So not surprisingly, Ethereum is flashing lots of warning cycles from the cycles, warning signs from the cycles, right? So if we, first of all, I like to just put my cursor here on the last data point and then look down the cycle spectrum column on the right there and just look at what's red and what's green. And pretty much everything is red, meaning all these cycles have been stretched to the max. And if we do look at the top cycles by stability, all of them are red, not surprisingly. And momentum, though, okay, momentum is at new highs right now, but not as high as it was back here. So here, anyway, look, momentum could go higher. It has not broken down yet. There's not a cyclic RSI sell signal on Ethereum, but it's definitely overbought. So I can't really be short Ethereum right now, even though all the cycles are converging here. I might go down to some shorter time frames and look and try to see. Let's go down and see what's happening at some shorter time frames on Ethereum. So here's hourly data. Okay. The spectrum here, 393, that's not, I don't have enough data, the 850 bars to really have that be valid. 231, The spectrum isn't really looking that great, but let's try to get some more data here. All right, so now we're starting to get some 132, 228, momentum, maybe some short-term support from the cycles on the hourly data, right? Especially with the daily data, you know, the momentum being this strong. So I'm not a bear on Ethereum yet, but you wanted to buy back here somewhere and not necessarily right here. All right, another one that was requested last week was HYG. So I'm pretty sure HYG is the high yield growth, but let me just go check. Yeah, high yield corporate bonds. Sometimes I like to go back and grab highs and lows if they're within, you know, a couple hundred bars of my basic analysis. So this is daily data on HYG. Add in some momentum. HYG is often correlated with equities. Certainly see momentum, negative momentum divergence on the highs here, right? And if I put my cursor over the last data point, see more red than green, especially in the top 4 cycles. Top 4 cycles are all pretty clear. I'm not sure there's enough data here to do this. 342, right? We only have about 1,000 data points, so there's like not even 3 iterations of that cycle. So it's a little shaky. That looks like a short to me. And I could go out and look at the weekly data on HYG. Use a little more data, just grab that low there. All right, so what do we got here on the weeklies? Got a pretty clear cycle here at 184. Stability of all the others is shaky, but boy, cycles do not look good for high yield bonds. So I think that contributes overall to our skepticism about the rally in equities here right now. Speaking of which, better give a quick peek and make sure nothing's going haywire. All right. And then the last request from last week was MSOS, which I believe, I don't know if that's a cannabis stock. It's an ETF. Okay, so a cannabis ETF. Woo! Look at that. Isn't it amazing, all these iterations of speculative mania? Cannabis back in 21, right? When it was, this ETF was at $52 and it basically made it down. It's down 90%. All right, so cycle-wise, what's happening here? basically got this 170 and 365, which are nice fractals of each other, and maybe this 93, although wish the stability was a little greater on that one. Momentum wise, woo. So we've got a high in momentum. Hasn't curled back in to the band, although it's looks a lot like Ethereum, doesn't it? It's gone up from $2 to $5, so very similar move percentage-wise, and even stronger momentum, I'd say, than Ethereum. So this is not a stock that I'd be interested in shorting, but if I weren't long already, I would definitely not be long. I mean, not be backing up the truck to get long. Maybe wait for a pullback and see what happens. But looks like very heady stuff to me, with very stretched cycles that don't look particularly sustainable. If you just look down that spectrum column there, pretty much everything is red. If we just said, let's look at all the cycles, okay, that's where we're at. Don't know if there's enough, there's probably not enough data to do a weekly analysis on MSOS. All right, so let's come back and go through your comments one more time. TECS, not sure what that one is. We can take a look. You can use HYG and SPI overlay composite and look for divergence between the two. Yep, and I think we're seeing a negative divergence in terms of HYG and SPY right now. All right, so we'll take a look at TECS and then a few thoughts to wrap up for today. Okay, so TECS. What is TECS? Direction Daily Technology Bear 3x shares. Oh, this was probably a idea for what to use to short. So obviously since April, right back here, this thing has gotten crushed because it's 3x bear. I'm not a fan of these ETFs, highly leveraged ETFs. I think crazy things can happen because of the volatility, right? But it's clearly you know, momentum is starting to skip off the bottom. I don't know if I could even do a cycles analysis on this one. I guess you could maybe go back a little further here. Yeah. Okay. If you're bearish, then and you're not afraid of levered ETFs, you can take a look. All right, so on our watch list, see if anything's popping out at us. I've been continuing to work with ChatGPT on my overall narrative here. Equities and crypto falling, topping risk, margin squeeze, short intermediate treasuries, yields rising. long treasuries, yields rising, gold falling, dollar rising, commodities and energy rising, inflation and unemployment rising. All of that lines up nicely with Michael Howell's late stage liquidity framework. And the move index tightening and bond yields rising all play into that as well. In terms of things jumping out at us and in terms of cycles, Berkshire Hathaway is one we've been keeping an eye on. I think everything else is already integrated into our portfolio, and still looking for more good diversified ideas to integrate into our cycles-based portfolio. Haven't found them yet, but we're on the hunt and don't have to make any moves necessarily, especially if we're expecting a pullback into October or so. But we're continue to be on the lookout to add some diversification to a strong portfolio, defensive portfolio, also supported by cycles. All right, everybody. I think that'll do it for today. Appreciate everybody tuning in. And again, put some comments in. Let us know you like it. Make sure you're subscribed. If you are interested in joining an unbelievable think tank of market analysts and cycles professionals and students, please consider joining our master working group. We have just a few slots left there, topping out at 50 members total. But you really support the work of the foundation and get tremendous benefit from really a group of masterminds. It's an incredible group. We get together a couple times a week, keep in touch on Slack, and incredible things are happening. So thanks for joining Cycles TV. Careful out there. See you again next week.